When investing in commercial real estate, you want to understand what your numbers are, how to read offering memorandums. When reading offering memorandums, you need to pay attention to current income, current expenses, and current net operating income. Today, you'll learn how to analyze numbers in 5 minutes or less to understand what kind of a return you're going to make on any investment when buying value-add real estate transactions. My name is Rafik Moore. I'm the founder of Brait Capital, an investment company that focuses on value-add real estate investing. In the past year, we bought over 2 million square feet of real estate, and we are actively stabilizing it right now across 8 states. Our approach is very straightforward. We focus on acquiring value-add assets with vacancies, with distress, with deferred maintenance, and actively improve these properties and stabilize them to allow them to serve the communities where they're located. Every day, we analyze deals, we analyze offering memorandums, and run our projections for future value and future net operating income. It's very important to understand the difference between the current NOI and the future projected NOI. Those numbers are essentially what determines your margin on any transaction. When assessing the viability of the deal, we look at it from a perspective of inputs and outputs. What is the NOI day one, and what is the projected NOI when the property is fully stabilized? Here's one of the case studies I'm going to talk about, a property we have under contract in Lansing, Michigan. This is a 44,000 square foot small bay warehouse situated on a highway on 5.8 acre parcel. It's listed by Martin Commercial of Lansing, Michigan. Children are very wealthy and don't want to deal with it. A father has died, and the asking price of this property is $2.2 million, which represents about $50 a foot on price. Lease rate on this property is about $12 per foot plus utilities and janitorial expenses. This means it's $12 gross. The operating expenses on this property are about $4. So when we talk about projected NOI, we multiply the square footage of the property, 44,000 square feet, by $8, which is triple net rent for the property based on our analysis of the expenses. This property has great exposure. It's got multiple units that are full. State of Michigan happens to be the biggest tenant in the corner, and their lease goes through 2031, which is really good. They're biggest tenants by size and by payments. These red units are vacant. The building was built in 2,800 square foot sections, and all of them have independent electric and HVAC. I've just arrived at Edgewood Technology Center in Lansing, Michigan. Came to visit this beautiful property that we're doing a case study on. Space number 4. These were built as offices then, right?
The building was built for flex space, although back in the day...
And you guys are marketing it for lease?
Yeah.
Any takers for the space?
Not yet.
What's the problem?
It's just finding... No.
Continuity of the rental income is one of the most important things in assessing the viability of the investment, because if a 22,000 square foot tenant leaves, you got to spend $50 to $60 a foot to bring that space back. That's what kind of makes us nervous.
What we need to do is remove all the offices, remove ceiling tiles, put in a garage door, put a little offices in the front, and that warehouse suite will rent for about $2,800 to $3,000 in that market. And so we have 2 units that are separate and then 2 units that are combined. What we are intending to do is look for 2,800 square foot tenant and 5,600 square foot tenant. And if we don't find a 5,600 square foot tenant, we'll chop the last large space into 2 little ones. We believe that demand for smaller spaces is higher, and the pricing for it can also get higher as well. When analyzing these deals, we focus on basis, we focus on the market rents, we focus on the vacancies in the area. We believe that this property stabilized could be worth as much as $4 million. However, buying it for $2 million today, and after spending $400,000 to $500,000 in tenant improvements, painting, improving the area, improving the exterior of the building, we will attract tenants and the property will be full. If you look at the picture over here, it's located very close to a heavily trafficked trade area. There's a huge mall there, there's a bunch of retailers, grocery store, highways, Aldi. So we believe that the area is very strong, and so one of our metrics in investing is to find properties in a really strong trade area with very strong fundamentals. Our goal is to always buy below replacement cost and below market. And that's why this particular property represents a great opportunity, as we will be able to stabilize it within 3 to 6 months, get our investors their money back through a refinance within 12 to 24 months, and establish a long-term cash flowing asset that will not only serve the tenants and the community, but also serve our investors in long term. Every time you look at a property, every time you assess the profitability of the property, first question you ask yourself, what can you do differently from the prior owner to unlock value in the property? And so, as long as you focus on adding value to the property, as long as you focus on adding value to the tenants and the community, you can unlock tremendous amount of value or wealth or cash flow for yourself or your investors. Please do understand that if you work on value add properties, your job is to add value through leasing, through construction, through, in this case, fixing electrical. Prior owner doesn't want to do it for whatever reason. If you have any questions, feel free to comment. Thank you for watching. Stay tuned and see you in the next one.